A sudden resignation, a stock market in a freefall, and a storm of utter confusion. Something is seriously wrong at India's largest private bank. So what really happened inside HDFC Bank? Let's get right into it. 1 lakh crore rupees. Just gone. Wiped out in minutes. Now, a loss that big doesn't just happen. It sends shockwaves through the entire market. So what was the trigger? What sparked this massive collapse? That is the big mystery we're unpacking today. Okay, so our story really kicks off with one single event. You could call it the spark, in a room just filled with gunpowder. It all started with a letter that, well, nobody saw coming. And things unraveled fast. I mean, shockingly fast. On March 18th, you have the chairman resigning. The very next day, the stock absolutely tanks, falling 8.7% and dragging the entire market down with it. By the time March was over, the damage was, well, it was catastrophic. Now, this is where it all gets a little weird. See, the chairman's official resignation letter was, frankly, explosive. He mentioned a clash with his personal values and ethics. But then, he gives an interview and completely walks it back, saying there was no wrongdoing, just ideological differences. I mean, which one is it? The market, as you can imagine, absolutely hated this confusion. And that really is the million-dollar, or in this case, the lakh crore question, isn't it? If this was just some simple disagreement, why did everyone panic and sell? Why run for the exits? The market's reaction, it tells you that investors believed there was something much deeper, much more troubling going on here. So let's start digging for clues. All right, clue number 1. This one takes us into the world of complex finance and a huge bet that went spectacularly wrong. We need to talk about something called AT1 bonds. Okay, so what in the world is an AT1 bond? The simplest way to think about it is it's like a bond on steroids. It pays you a way higher interest rate, which sounds great, right? But here's the massive catch. It has no expiry date, and this is the scary part. If the bank runs into any kind of financial trouble, your entire investment can be legally wiped out. Poof, gone. Think of it this way. When you buy a normal bond, it's like lending money to a friend with a clear return date. It's pretty safe. You know you're getting your money back. But with an AT1 bond, it's different. You get more interest, sure, but the company can basically keep your money forever. And if things go south for them, your investment could just vanish. You're no longer a priority lender. You're treated more like a shareholder, taking on all that extra risk. So how does HDFC Bank fit into all this? Well, according to reports, the allegation is that they marketed these super risky Credit Suisse AT1 bonds as safe, high-return investments, especially to their NRI clients. We're talking promised returns of around 10 to 13%. Then they allegedly helped these clients move their money to buy these bonds, but, and this is the key part, without fully explaining just how massive the risks really were. And then the unthinkable happened. In March of 2023, the global banking giant Credit Suisse, the company that issued these bonds, completely collapsed. Suddenly, all that theoretical risk, it wasn't theoretical anymore. It was very, very real. The fallout from this was just mind-blowing. Swiss regulators stepped in and ordered a complete write-off of all Credit Suisse AT1 bonds. That's a staggering $17 billion vanished. Every single person holding these bonds, including, yes, potentially those NRI clients, lost every single penny overnight. So that's our first big clue. But believe me, the story gets a lot more complicated from here. All right, let's move on to clue number 2. This one has to do with that massive historic merger back in 2023 between HDFC Bank and its parent company, HDFC Ltd. Now, on the surface, this deal created an absolute financial giant. But peel back a layer, and you start to see some very serious problems. So here's the problem. HDFC Bank basically absorbed this huge book of home loans from HDFC Limited. But HDFC Limited wasn't a bank, so it didn't have what banks need most, cheap deposits, from savings and current accounts. This created a huge fundamental mismatch. And you can literally see the damage this caused right here, in the numbers. The bank's main profit engine, what we call its net interest margin, got squeezed big time. It fell from a really healthy 4.1% all the way down to 3.35% after the merger. That's even below its main competitors. And the reason is simple. It was now stuck funding expensive loans with expensive money. But wait, there was another hidden cost, one that almost no one was talking about: banking regulations. You see, as an NBFC, HDFC Limited got to play by a different set of rules. But the moment it became part of the bank, bam, all the banking rules applied. And a big one is that about 21% of its deposits now had to be parked with the RBI, earning next to nothing. Let me put a number on that for you, because it's huge. We're talking about 1.3 lakh crores of capital, just sitting idle, doing nothing, just to meet these new rules. That is a massive amount of money that could have been out there earning interest for the bank, but instead it was just stuck. All of this pressure created a really dangerous situation, which you can see in one key number: the loan-to-deposit ratio. It shot up to 110%. Just think about what that means. The bank had loaned out more money than it actually had in deposits. Now, to be fair, that number has gotten better, but it's still way above what the RBI considers a safe level.
Okay, so let's put the pieces of the puzzle together. You've got the whole AT1 bond mess on one hand, and this immense pressure cooker of a merger on the other. And when you combine these two, you get to the real crisis, the thing that matters more than anything else in banking: a crisis of trust. It really was the perfect storm. First, you had the huge hit to their reputation because of the AT1 bond controversy. Second, you had their profits getting squeezed hard by the merger. And third, you had this really risky situation on their books, with way more money going out in loans than was coming in through deposits. And this right here, this is the most important point of all. In the world of banking, you can have all the money, all the capital in the world, but if you lose the people's trust, you have absolutely nothing. Trust is the real currency of banking. And that's what makes this whole situation so shocking. For decades, HDFC Bank was the gold standard. It was that one buy-it-and-forget-it stock that let you sleep peacefully at night. It was seen as India's most reliable, most dependable bank, and now, well, that entire perception has been shaken to its core. So all of this leaves us with one final crucial question. Look, numbers can be fixed over time, and profit margins can be improved, but a damaged reputation, that is so much harder to repair. The big question now is, can India's biggest private bank actually navigate this storm and win back the one thing it absolutely cannot afford to lose: the trust of its investors? Hey, if you want to keep breaking down complex stories like this and get straight-up financial insights, make sure you subscribe to Finance Made Easy Pro. Thanks so much for watching.